Hi, everybody. It's Joshua Hayes, and we're here with part one of the stock market wrap-up for September 21st for you to use on the September 22nd session. I apologize. I have not had some videos the past few days at all, I don't even think. I can't remember the last time I made a video, but I got to admit, I'm in a situation right now that's very odd, very difficult to go through, and there's a lot of, I guess, moving around, having to do things in a very unusual pattern, I guess you could say. So if there are a couple more videos missed, it would happen from today till Thursday, maybe Wednesday only, and then hopefully we'll be back on proper schedule here. What I want to go over today is, I tell you what, I wrote a Insta blog yesterday on Seeking Alpha about not trying to call tops, or if you do try to call tops, it's okay as long as you don't short your calls. I know some people that keep on calling tops, keep on shorting, keep on getting stopped out, then are re-shorting. So I wrote a column to Seeking Alpha as an Insta blog, and they picked it up and published it. So thank you very much. But it's a very good column, and I suggest everybody read it if you have not. It describes the way that I've seen some people trading this rally. Now, I was lambasted by a former member who actually unsubscribed that I'm out of touch with the market. You poo-pooed the rally the whole way up. I sure did. But guess what? I kept on buying stocks, didn't I? And that's the key to remember. You can have any opinion you want about the stock market. However, what really matters is what you're doing. So from March to about May, I'd say even June, I did not like this rally. No hot can slim charts. When the can slim charts did set up in stocks like ARST and STAR, and a few others, besides the Chinese ones. Let's ignore the Chinese stocks. They all failed. They all did not go up. They reversed, and they hit me with small losses. Some of them, most of them I was able to get out with a quick gain because they shouldn't fall that fast. But the bottom line is, look at this market trend. I told you, one of the safest ways to know when you should be buying or shorting the market is this. If you went short the market only after, once the 50-day moving average crossed below the 200-day moving average, held that position until the 50-day moving average recrossed above the 200-day moving average, you would have been short from January 2008 to about the early part of June. Now, if you were still short after the 50 got above the 200-day moving average, with price above the 50 and 200-day moving average, you right there should have called it in. That's when I called it in. That's whenever I got the email. Thank goodness, since then, I've been doing nothing but buying stocks, haven't even really been shorting, and it's really been paying off. So I have to admit, I'm very, very, very happy with the way that this market is acting. The only thing I'm not happy about is look at this constant uptrend. From March to September, there is absolutely no pullback. So continue to buy the stocks. Look at the volume recently. I want to show it on a weekly on the NASDAQ. Look at what's starting to really show up now. 1, 2, 3, 4, 5, 6 green bars above average with only one red below average since the month of about May, I guess. Maybe April. No, middle May. So it's clearly under accumulation. Today, the stock market opened at its lows for the NASDAQ, almost, got a little bit lower, and then moved on up into the end of the day whenever there was a quick flush out, and then a nice little move back up. Look at the NASDAQ's relative strength line today, though. Boom, 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 boom. Gotta say, that white line on the bottom, I like it. New York Stock Exchange pulled back today. Start of a new downtrend? Okay, bears, call it all you want. Guess what? Low volume. Low volume pullback, bullish intraday tail. Okay. The S&P 500, once again, very bullish tail. Low volume below average on the selling. Oh, it sure does look like the bears are in control here, doesn't it? Look at all these open body candle prices on the daily chart that I have here from August, September. It tried to roll over twice in August, and look at how that was met. Support before it could even get to the 50-day moving average. Heck, the S&P 500 doesn't even know what the 50-day moving average anymore, as it hasn't seen it since July. It's a far glimpsing, fading memory, just like the 200-day moving average. This is all positive, by the way, as long as stocks keep showing up like they are. Dow Jones Industrial Average, look at that, below average volume. There was only one index with above average volume, and that was the NASDAQ. And as you can see, it was up today, closing in the upper half of its session, only 4 points away from the high of the day, and that flush at the end is what killed it. But obviously, these charts are extremely bullish. To go short them is just straight up suicide. S&P 600, there's a tail. Mid-cap 400, which is probably one of the better performing indexes. Once again, another tail. Things are looking real good. The IBD indexes I can't show you. I will show subscribers in video 2. So let's just skip those for now. However, they are leading recently. Gold, it pulled back, I believe, 5 points today or something like that. I don't know. So that's where it's at, I guess, like 105. Whatever. We got to wait for all these to update, so there's no point in even going over them. So I'm going to go ahead and wrap up video 1 there. First off, I just want to go to my scans really quick and show all you guys how bullish this market is. Here's my scans for today. There's going to be 262 stocks. Look at the stocks in this scan. Does that look ugly? Has anything I pulled up so far as I'm flicking through these been ugly? If you've answered no, you're right. These beautiful charts only come when markets are going to rally. And with the way that this looks, let's go to an arithmetic and see if anything's getting extended. Okay. Doesn't really like anything's crazy. What does extended look like? You may not remember. Baidu. Look at 2007. Goog. Look at 2007. RIM. Look at the end of 2007. JDS Uniphase. Let's go back to 2000. Look at that. Look at that. Qualcomm. Look at that. eBay kind of in 2004. Those are climatic moves. But do we have a Qualcomm? A JDS Uniphase? What else existed then? Intel? Cisco? Do we have that right now? Let's look at one of my best performing ones. PXLW. If anything's going to look parabolic, this one is. Does that look parabolic to you? Shorts. Guys, you can be bearish on this market like I was up until June. Not happy with the rally. However, I was buying stocks the entire time. You guys that are shorting every uptick, just think about all the money you lost by not going long a stock like CVM 8 days ago, which was a long for us, which is now up 141%. Kind of stings when you're taking losses all the time by shorting a rising market. What is my main axiom? Never short a market heavy with the price above the 50 when an uptrending 50-day moving average, especially with an uptrending 200-day moving average. This is the most bullish you can get. 200-day moving average uptrending, 50-day moving average uptrending, price uptrending. 50-day moving average was downtrending, price was above the 50-day moving average, 50-day moving average was uptrending in June, and look at how it turned out. So this is not the time to be shorting the market. The time to be shorting the market is when you actually get real distribution. And let's go back and review the 2007 top really quick. Look at all the big red bars that are showing up. Look at those big giant red bars. That's it. If you were still in this market after the 11, 12, you're nuts. Got the bounce, more breakdown. Come January, look at the 50 now cross the 200-day there. That's it right there, 117. If you're not out of this market, this is what you got. Not good. Not good. So heed that sign, heed those warnings, and please listen to your price and moving average clues. Okay, I'm going to go and wrap it up there. Aloha, everybody. I'll be back with part 2 for subscribers.